Breaking news in the world of finance: Apple, the most valuable company on planet Earth, is surging dangerously close to its 52-week high, and right now, every investor on Wall Street is asking the same burning question: do you buy, do you sell, or do you hold? Let's break this down fast because this is moving quickly and you need to know exactly what's happening. Apple's stock, trading under the ticker Apple on the Nasdaq, has been on an absolute tear in recent weeks, climbing steadily toward that critical 52-week high watermark. When a stock of this magnitude, we're talking about a company with a market capitalization hovering around $3 trillion, approaches that ceiling, it sends shockwaves through the entire investment community. This isn't just any stock. This is Apple, the iPhone maker. The company that essentially lives inside the pockets of over 1 billion people worldwide. So why is Apple trading this high? Several forces are converging at once. First, investor confidence in Apple's services division continues to skyrocket. We're talking about Apple Music, Apple TV+, iCloud, the App Store, a recurring revenue machine that is becoming increasingly resistant to economic downturns. Unlike hardware sales, which can fluctuate with consumer spending, services revenue keeps flowing. Analysts have pointed out that this segment alone is dramatically reshaping how Wall Street values the entire company. Second, there's the artificial intelligence factor. Apple has been quietly but aggressively positioning itself in the AI race. With Apple Intelligence features rolling out across its ecosystem deeply integrated into iOS, macOS, and beyond, investors are pricing in the possibility that Apple could dominate consumer-facing AI in a way that no other tech giant can match, simply because of the sheer size and loyalty of its existing user base. That's a narrative that gets traders extremely excited. Third, institutional buyers have been steadily accumulating shares. When you see the smart money hedge funds, pension funds, major asset managers piling into a stock near its 52-week high, that's not something you dismiss lightly. That's a signal that big players see more runway ahead. But here's where it gets tense. Trading near a 52-week high is a double-edged sword. Technical analysts are watching critical resistance levels extremely carefully right now. If Apple fails to break cleanly through that ceiling with strong volume, history tells us we could see a sharp pullback as profit takers rush to cash in their gains. Momentum can reverse with stunning speed at these levels, and retail investors are often the ones left holding the bag. The valuation debate is also heating up. Apple currently trades at a price-to-earnings ratio that has some veteran analysts raising their eyebrows. When you compare that multiple to the company's actual earnings growth rate, the bulls and the bears are in a fierce argument over whether this price is justified or whether the stock has simply run too far, too fast. For long-term investors who believe in Apple's iron grip ecosystem, its unprecedented brand loyalty, and its AI-driven future, the argument for holding or even buying on any dip remains compelling. Warren Buffett's Berkshire Hathaway famously made Apple its largest position for years for exactly these reasons. But for traders with shorter time horizons, the risk-reward calculation near a 52-week high demands serious caution. Stop losses need to be tight. Positions need to be sized appropriately. The upside from here may be limited in the short term, while the downside risk, if sentiment shifts, could be significant. The bottom line tonight is this: Apple near its 52-week high is not just a stock story. It's a referendum on the future of technology, artificial intelligence, and the global consumer economy. The real question isn't whether Apple can break through this high. The real question is, can you afford to be wrong about it?